investing in the financial markets has long been considered one of the best ways to accumulate wealth over time. As people search for the best investment vehicles to grow their money, index funds and exchange-traded funds, ETFs, consistently emerge as two of the most popular choices. While both offer a simple, diversified approach to investing, they each come with distinct features, advantages, and disadvantages. In this guide, we will explore the key differences between index funds and ETFs, providing you with a thorough understanding of which may be better suited for your financial goals and risk tolerance. Understanding index funds and ETFs. Before diving into the comparison between index funds and ETFs, it is essential to first understand what each of these investment vehicles represents. An index fund is a type of mutual fund that aims to replicate the performance of a specific market index, such as the S&P 500. The goal of an index fund is to passively track the index by holding the same stocks in the same proportions as the underlying index. Index funds are often used by long-term investors who prefer a low-cost, hands-off approach to investing. An exchange-traded fund, ETF, on the other hand, is also designed to track an index, but it trades on an exchange like a stock, meaning it can be bought and sold throughout the trading day at market prices. Similar to index funds, ETFs offer diversification and typically have lower fees than actively managed funds. However, they offer the added benefit of liquidity due to their exchange-traded nature. Structure and liquidity. One of the most significant differences between index funds and ETFs lies in their structure and liquidity. Index funds are mutual funds, meaning they are bought and sold through the fund company at the end of the trading day at the net asset value, NAV price. Investors cannot buy or sell shares of an index fund during market hours, and orders are processed at the close of the trading day. ETFs, by contrast, are traded on exchanges like stocks, which means they can be bought and sold throughout the day at market prices, similar to individual stocks. This provides greater flexibility and liquidity for investors, allowing them to respond to market fluctuations in real time. While index funds can only be bought or sold once per day, ETFs allow for intraday trading. This feature is particularly advantageous for investors who prefer to make quick decisions based on market movements. However, it also means that ETF investors must be more mindful of short-term price fluctuations, which may not align with the long-term investment strategies of those using index funds. Cost and fees. When it comes to cost, both index funds and ETFs are generally considered low-cost investment options compared to actively managed mutual funds. However, there are subtle differences between the two. Index funds typically have lower expense ratios than actively managed funds but can have slightly higher fees compared to ETFs. The reason for this is that index funds are usually mutual funds and may have administrative costs associated with the fund's management. These fees are still relatively low when compared to actively managed funds, but they may be slightly higher than the cost of investing in an ETF. ETFs, on the other hand, usually have lower expense ratios compared to index funds. Since ETFs are passively managed and traded on exchanges, they generally have lower operational costs. Additionally, because they are traded like stocks, investors can buy and sell ETFs without paying sales loads or commissions typically associated with mutual funds. However, there are transaction costs for buying and selling ETFs, such as brokerage commissions and bid-ask spreads, which can vary depending on the platform used. Tax efficiency. Tax efficiency is another critical factor that differentiates index funds and ETFs. Both index funds and ETFs are considered tax efficient compared to actively managed mutual funds because they have low turnover rates, meaning they don't buy and sell securities frequently. However, ETFs generally have a tax advantage over index funds. The reason for this is that ETFs are structured in a way that allows investors to buy and sell shares without triggering capital gains taxes. This is due to the in-kind creation and redemption process, where large investors, known as authorized participants, can exchange shares of an ETF for the underlying securities without triggering a taxable event. This feature makes ETFs more tax efficient, especially in taxable accounts. Index funds, on the other hand, may generate taxable capital gains if the fund manager needs to sell securities to meet investor redemptions. While index funds tend to have lower turnover rates compared to actively managed funds, they do not offer the same level of tax efficiency as ETFs. Investment minimums. Another key distinction between index funds and ETFs is the minimum investment required. Index funds often have minimum investment requirements, which can vary from fund to fund. These minimums can range from as low as $500 to as high as $3,000, depending on the fund provider. ETFs, however, do not typically have a minimum investment requirement. Instead, the only barrier to entry is the cost of purchasing a single share, which can vary depending on the ETF's price. This makes ETFs more accessible to smaller investors who may not have enough capital to meet the minimum investment requirement of an index fund. Dividends and distributions. Both index funds and ETFs can generate income for investors through dividends and capital gains distributions. The key difference lies in how these distributions are handled. In an index fund, dividends are typically paid out to investors on a quarterly or annual basis, and they are automatically reinvested unless the investor opts to receive cash payouts. Since index funds are mutual funds, they distribute any capital gains from the sale of securities to investors at the end of the year. For ETFs, dividends are also paid out to investors, but they are distributed directly to the investor's brokerage account. Additionally, ETFs do not have the same capital gains distribution structure as index funds. Instead, the capital gains are typically realized when an investor sells their shares, and the tax implications depend on the investor's individual circumstances. Flexibility and strategy. The choice between index funds and ETFs ultimately depends on the investor's strategy and preferences. Index funds are ideal for long-term investors who are looking for a low-cost, hands-off approach to investing and are comfortable with buying and holding their investments for the long term. Index funds are a great option for retirement accounts like IRAs and 401(k)s, where investors can benefit from tax-deferred growth and don't need to worry about trading during the day. ETFs, on the other hand, are more suitable for investors who want the flexibility to trade throughout the day and are comfortable with the associated transaction costs. ETFs are often favored by active traders and those who want to take advantage of market volatility. They also provide more flexibility in terms of portfolio customization, as investors can buy specific sectors, industries, or geographical regions. Which is better for you? Now that we have examined the key differences between index funds and ETFs, the next question is, which one is better for you? If you're a long-term investor looking for a simple, cost-effective way to gain exposure to the broader market, index funds may be the right choice for you. They offer a passive investment strategy with low fees and minimal effort on your part. Index funds are also a great option for retirement accounts where you can benefit from tax advantages and a more hands-off approach. However, if you're looking for more flexibility, greater tax efficiency, and the ability to trade throughout the day, ETFs may be more suited to your needs. ETFs offer lower expense ratios, more tax-efficient structures, and the ability to take advantage of market timing. In the end, both index funds and ETFs are excellent investment vehicles that can help you achieve your financial goals. The best option depends on your investment style, risk tolerance, and financial objectives. Whichever you choose, remember that investing in diversified, low-cost funds is one of the best ways to build wealth over the long term. When deciding between index funds and ETFs, there is no one-size-fits-all answer. Each has its own set of advantages that cater to different investor preferences. Index funds are a great choice for long-term investors who prefer a set-it-and-forget-it strategy, while ETFs offer the flexibility for those who wish to trade actively and benefit from their liquidity and tax advantages. The key is to carefully evaluate your personal financial goals, risk tolerance, and investment strategy before making a decision. By understanding the unique features of both index funds and ETFs, you can make an informed decision that aligns with your investment objectives. No matter which option you choose, remember that the core principles of investing remain the same. Diversify, minimize fees, and stay invested for the long haul.